Welcome to Investor in the Family Radio, a podcast dedicated to helping you make better investments in less time so you can live more life. My name is Brian Bain, and I'm your host. You can find more shows and other valuable content at investorinthefamily.com. Well, on today's podcast, we have Doug Eberhardt, and Doug has been on the podcast before, and he's been on several summits with us, and always a great interview, especially when discussing gold and silver investment. Doug, welcome to the show.
Thanks for having me, Brian.
Absolutely. And recently, Doug wrote an article and actually a podcast as well on Seeking Alpha titled $50,000 Gold and John Exter's Pyramid. That's right, 50,000 gold and John Exter's Pyramid. And you can imagine anytime a bold claim regarding gold is made, lots of people have opinions. And this article is no exception. As of what today is June 19th, there were 558 comments. That's remarkable. So you clearly struck a chord with a few people.
Well, I think part of the reason you strike a chord is by putting something that some would view as being outrageous. And that number actually came from a guy who's over 80 years old and used to be in the gold mining business and is the son-in-law of John Exter. And if you've done any homework on John Exter and his inverse pyramid, you can see that we do have a potential of money flowing down his pyramid, trying to find a base, which is gold and silver as a safe asset, even though the last probably since, 2011 highs, it's been kind of a dog overall.
Sure. Well, let's start there. Assuming the audience is not already familiar with the John Exter's Pyramid, and can you give us a background? Like, what is that, and why should we care?
Yeah, John Exter is what Barry Downs, his son-in-law, the guy I interviewed, called the only honest banker, or honest central banker, excuse me. And he was a central banker back in the 70s, and he is a critic of central bankers. Even back then, when they first started to put a little bit of debt on their balance sheet, he was saying at 80 billion that the Fed was out of control, and now they're at 4.4 trillion. And you add to that, he was around in 1971 when Nixon took us off the gold standard, and things were a little bit different then, and things have been great ever since 71 for things like the stock market. But there's still this group of people, call them gold bugs or whatever have you, that kind of puts or looks into the future a little bit and kind of sees that there's some cracks. And John Exter was seeing it back then, and what we have today with a $21 trillion debt and a Congress, both sides actually, Democrats and Republicans, that really has no clue as to saving money or living within a budget, looking at cutting debt any way they can. There's just no fiscal bone left in Congress. And so central bankers today kind of accommodate that with their interest rate policy, keeping rates artificially low. And maybe we can get into that a little bit deeper as far as what central bankers are doing today versus then.
Absolutely. Okay, so that's a little bit on John Exter, and I've got several comments I could make there, but I want to, is now good, you want to talk about the pyramid now, or would it be better to lay some more foundation for that? No pun intended.
It's a good time anytime to talk about the inverse pyramid because you just can't find much information on it. And
right.
The one thing that stands out about the pyramid is you can ask the questions as to what it means. Typically, the inverse of a normal pyramid where they have gold at the top, instead gold's at the bottom of this pyramid. Most people think gold is a risky asset, yet the gold itself hasn't changed over time. You bury it in your yard 20 years ago and dig it up today, it's the same gold. It's only what it's priced in that changes. And that's why he has gold sitting outside the pyramid, because it doesn't change, whereas every other asset in the pyramid, from the riskiest being derivatives, some real estate trusts, to stocks, to even bonds, junk bonds, it flows down from risk to safety. And at the bottom of the pyramid are treasuries, which are viewed as a no-risk asset for most. Yet when interest rates rise, the Treasury's value goes down. So there's risk there too. And then cash, of course, at the bottom of the pyramid, and then gold and silver technically sitting outside the pyramid.
Right. And yeah, I just pulled up a copy of that from your article. Yeah, so at the very top, you've got derivatives, then non-monetary commodities, corporate and municipal bonds, then government bonds, then bank money, then base money, and then gold. And so all those are like a descending, like I said, in an upside down pyramid, all kind of siphoning back down with gold at the bottom. And the numbers of those different levels are just astounding. Obviously, with derivatives at the top at $1 quadrillion. And the thing is, I've had some conversations with people before about, obviously, I mean, better than I do. There are lots of different opinions on the pyramid in terms of people who agree with it, and obviously plenty who don't. And there's just disagreements about what happens if, for example, like derivatives, if the derivatives market or aspects of it crash or have troubles, whether or not those things just evaporate into nothing, or if there actually is a collapsing of dollars and money down into gold. And honestly, I don't know what would happen in those situations, but when I look at this chart, even if you cut out those first couple of huge levels at the top, there's still a tremendous amount of value, I guess I could say, that could descend down in the gold in the scenarios that I guess we'll talk about here in a few minutes. And feel free and speak against that too. I'm just kind of processing it myself a little bit.
Sure. I think derivatives, at least people think they're under control right now, but you're seeing with the elimination of Dodd-Frank again, and banks having as much control as they want, getting away with what they want, and no moral hazard for what they do, you're seeing them dip back into the risk assets. Back in the day of Exeter, the bank actually would make small loans and some big loans and have some sort of a cap on the interest rate, or they were all fixed, and they would have a situation where they would know that loan would be paid back, based on the credit worthiness of the one taking out the loan. And today you see a lot more of repeat, really, of 2008, 2009, when interest rates started to go up because of the moves that were made by the central banks and the Fed. And we're seeing right now the same scenario. So in 2008, 2009, we had a kind of a mini crash. Kind of money did flow from the derivatives on down that pyramid. But gold and silver got hit too, and we can address that a little bit later. But what it shows is that all assets, and I'm a biggest gold bug around there, but I'm saying gold can get hit too, including gold mining stocks, once this unraveling begins. And so the question is, what will set it off? And there's many things that can set it off, but it's really the Fed policy with interest rates that will drive this pyramid down. And it's really the perception that the Fed is not covering all bases and viewed as weak that I think sets it finally off.
So, and just again to summarize a little bit, because I think I interrupted you a while ago, and for some people who aren't as familiar, so the general idea of this pyramid is that at some point, this big kind of financial, I'll say, house of cards that's been developed in the last 40 to 50 years is going to come tumbling down because it's not sustainable because of the excess and debt and other dynamics. And when that collapses, there's all of these dollars, all this perceived or real value that's out there, either in derivatives and non-monetary commodities and bonds and bank money and all that kind of stuff. And that value has to go somewhere. And the idea is that will kind of collapse downward in this pyramid, ultimately leading toward a really extreme escalation in price for gold and silver. Is that a fair representation?
Yeah, what will happen is the bids disappear on risk assets, because who's going to be buying something that's falling, let alone crashing? And so when bids disappear, the person who's trying to liquidate their asset, whether it's derivatives or real estate or anything illiquid, is going to have issues. And so the bid will drop, and it'll drop considerably. And Barry Downs talks about in the podcast that back in 1987, you didn't find any bids on some assets. And that's where the problem is people think they're wealthy now, but how liquid are they to turn that money into whether it's cash or gold or silver or something else that they have a little more faith in. And so that's where it comes into play.
And so you said, some of these riskier assets, the bids disappear, meaning there's no one who wants to buy them, and people are desperate to liquidate those assets because they're dropping in value. So what's the next step? How does that unravel the pyramid?
Well, it unravels quite fast,
right,
as it did in 2008, 2009. And we saw gold fall 30%. We saw stocks fall a little bit more than that. And then gold and silver eventually went off to new highs by 2011. So within 2 years, we were taking off in metals. And stocks, it took them a little bit longer. So you'll see the same kind of repeat. I would call that 2008, 2009 period a mini crash compared to what I see coming.
Okay. And again, if I own derivatives and a high risk asset, and there's no bids, I'm trying to get rid of those. So basically, the unraveling happens because if I own those assets, I'm trying to liquidate them and I can't. So forgive me. What do I do at that point as the owner of those derivatives that helps trigger this unraveling or helps? I guess basically I'll take any price basically, and so that's why the price of derivatives will drop and collapse because I'll sell for anything at that point. Is that kind of the idea?
Well, in a worst case scenario, it would be that way for derivatives, especially anything risk in derivatives, not as much interest rate swaps or anything like that.
Right.
And that's what most derivatives are. So I'm not as fearful of that. But when you see things start to crash, it'll be similar, I think, to a 1987 scenario. Maybe not in one day, but over a little period of time, a few weeks or something, where it's that fear that sets in that is going to cause people to panic. And we've seen it happen once already, so we know it can happen. And at that point, actually before that point, the Fed will do all they can if they see any writing on the wall that their monetary policy is not working. And I'm confident in that they will not raise interest rates the rest of this year and even talk about introducing QE again, because I think kind of what we're seeing a little bit the last few days with interest rates falling and with the stock market a little bit shaky, especially the international markets, and the stronger dollar is kind of killing everything at this point. I see some aspect to the Fed kind of pulling back on what they think they're going to do. I think Bullard even mentioned something on Monday about it. So what's going to happen in these next few weeks might dictate maybe one more trip up in the stock market. Gold and silver should probably bottom where they are now in a short term, but come September, October, that's my time period of what I see a lot of this unraveling, and I think it'll happen pretty quickly.
And forgive me, I probably asked some questions, maybe obvious, maybe repeated questions, just because I don't want to end the interview or to have people in the comments thinking, well, what about this or that? Yeah. And so again, so let's leave derivatives behind. But I guess so. Basically, the collapsing. Well, I guess maybe here's my question: when this unraveling starts happening, how does that? I guess the reason that benefits gold and silver is that the typical flight to safety type idea? Basically, these riskier assets are collapsing in value, and people want to put their whatever capital they have left from those riskier assets into something really stable. Is that essentially the idea?
You'll have your group of people that'll buy gold on any pullback, but I see gold and silver collapsing at the same time with everything else. So it's not going to be anything that you could put your money into except treasuries or cash for that time period where I see this happening. And there's nothing wrong with that. We in the Illusions of Wealth trading service I have, we buy ETFs, whether we go up or down, we don't really care. We just want a trend. And then I do try to predict what I see coming next based on all these economic conditions that we're in. But when that crash happens, gold and silver will get hit as well. And I tell people now, buy half because it's at a discount to where I think we're headed for the summer. And then if we do get that crash, have some cash ready to buy more. And how low we go, I don't have an answer for. But after interviewing Barry, I'm more confident in physical gold and silver, at least, as being a place as insurance for the rest of your portfolio now more than ever. And I have not in the last, I've been writing for Seeking Alpha since 2009. I have not since, I think 2011 or 12, been a fearmonger, a dollar crash guy. I've at times been very much a bull. I'll be a bull in September. And I just see gold and silver having that one last leg down. Where it bottoms is a tough call. Will it get down or break 1,000? It might. If it gets down to 1,200 or so, I'll probably make my decision then, because we'll be at a lower low than where we're at now.
And so when the unraveling begins that you're discussing, so actually, like you said, back in 2008, 2009, that actually won't be the best time to own gold and silver, because you said, I guess at that point, treasuries and the dollar will still be seen as a more liquid and safe enough asset, basically.
Sure, more today than at any time. I think you'll see treasuries shoot up, TLT and TMF will shoot up, and then we'll also have the dollar probably go over 100 and maybe even push towards 120. Wow.
And so how does that then turn around and help? How does gold end up benefiting from that?
Well, gold should have a run up to the 1,400 to 1,500 level, hopefully closer to 1,500, maybe a little above that. Then we should have a little bit of a scare maybe come that September, October. And at that time, it's holder of physical gold and silver, by the way, they never sell.
Right.
But what they'll do is they'll find ways to find cash to load up and buy more, assuming I'm right about what happens with Exter's pyramid and we flow down that pyramid from risk assets to a base of the dollar in treasuries. But at some point, as Barry and I discuss in that podcast, there's going to be a time when treasuries start to kind of crack. And at that point is when gold and silver will start taking off. And so the question becomes, as far as what price to buy at for gold, it's going to be a time when you start to see the treasuries crack. And so I'll be able to judge that, live, or I'll write articles about it. When I say all in, I'll mean all in. It's hold on for the long run.
Of course, at the same time, the title of your article was saying $50,000 gold. And if that's the case, then today's prices aren't too bad either way, right? I mean, if you're talking, obviously, it's if you can get gold at 1,000 versus 1,280, that's better. But I'd rather get it at 1,280 than 15 or 2,000 at the same time.
Sure. Barry mentioned 50,000 gold because I pressed him on it. I asked him that question. I go, where do you see gold going to? And the way he referenced that or prefaced that was that if we are in some sort of a monetary collapse, and it's kind of hard to imagine a monetary collapse when the dollar is made up of the yen, the euro, and the pound primarily, because you can't have a dollar crash and have those shoot straight up because they have the same issues we do. So it'll take more of all currencies to buy gold once we start taking off over, let's call it 1,600, maybe 1,700. And we won't look back. So the last time to buy gold or silver, I think, will be during that deflationary crash. And where it goes to in price after that, it's not as much that we hit 50,000 and the Fed can't have any or doesn't have any answers. It's more a matter of reframing your thinking that gold is insurance and it's something you may not want to sell, or at some point in the future sell for a beaten down stock market, a beaten down real estate market, or something else. And that's what asset allocation models say too. And right now gold is high, gold is low, the stock market's high. And that's why I say half in now and then half in if we get that crash.
And again, this is a crash you're anticipating before the end of 2018.
I am. I don't usually put a time frame on things, but for the first time, I am calling it the September, October. time frame. And one of my reasons is I wrote an article also on Seeking Alpha about the price of gold and guns all falling ever since Donald Trump got elected president. And I documented based on U.S. Mint sales of gold and silver, which have crashed. And whether it's, and by the way, it's mostly Republicans who actually buy gold or silver. So if for any reason November, or there's a sign in November that things are working well and the economy or stock market that Donald Trump keeps talking about doing so well, and the economy starts to crack a little bit before November, then it's going to be a better sign that Democrats will come in. And I think by that time, gold and silver would maybe have bottomed already, and then we're off to the races.
And again, and the $50,000 number isn't necessarily your prediction, but you said Extra's, is it his nephew, Barry? Is that right?
It's his son-in-law, Barry.
His son-in-law.
Yeah.
He predicted 50,000. And is that, and I noticed, early in the comments of your article, Avi Gilbert, who I've had on the show a number of times and a big fan of Avi, and I know you and Avi are friends. And you guys had a exchange right there at the beginning about, you mentioned Barry Downs mentioned $50,000 gold, and Avi's mentioned 25,000. And when Avi's talked about, gold, he's obviously it's anyone's, it's not just like you and putting a time in the crash. You're going to be a little conservative because we don't really know what's going to happen. But he didn't really give dates, but he talks about a really long-term bull market, in gold beginning perhaps this year. So that idea being out there, and he's saying, $25,000 being conservative number, then Barry Downs is saying $50,000. Is Barry saying $50,000 like in the next couple of years, or like 20 years from now? I mean, is that something he got into very much?
Well, I think what you're really asking is when is all this going to come to a head?
Sure.
I see something happening later this year where things are going to crash and do so quickly. If the Fed, and I did ask him this, raises rates at some point, not like they're doing now, but down the road, when is the end game is what I asked him. And his prediction was that when we hit about 6% in interest rates. So this next article I'm writing for Seeking Alpha has a lot to do with the national debt and an analysis there. And the Fed still has a lot of tools. They can lower rates still from where they are now, and they can also go negative rates. And there has been some people writing about that. So I addressed that in this next article. What happens once we take off above 6% is you've got a national debt interest that has to be paid, that is going to be something that Congress can't have. And it doesn't matter who's elected in this fall or in 2 years or whatever it is. It's the fact that we have a relationship of the U.S. dollar without gold for only 47 years. And everybody thinks everything's hunky-dory when you have 21 trillion plus of debt and trillions of unfunded liabilities and a lot of credit that's out there. So that's why I always talk about a deflationary credit contraction that will maybe extend a lot longer than people think. It's going to start with a crash, and then you might have a bounce up again. And at some point, there's still going to be issues. And when you look at all of that future liability that's just sitting out there, and it's the elephant in the room nobody talks about, then you've got to have some insurance for that. And that's how I view gold and silver.
Well, and I appreciate you mentioning specifically the 47 years piece, because it's so funny to me. Well, it shouldn't be surprising, but the fact that we're in a period where gold and silver is you mentioned earlier in the interview, hated and mocked by so many, especially in the financial industries. You would create terms like gold bug and stuff like that usually, some people say it as a term of endearment, but usually it's said as a kind of a dismissive comment by a lot of people in the financial sectors. But it's so funny because this period that we're operating in, it's only 47 years old. And outside of these 47 years, for most of monetary history, gold has been a foundational piece of any kind of monetary system. But again, I guess it was in 71 that changed. And now it's like, oh, well, that was just an old historical thing and that's over and done with. And it just seems like, if I'm going to fall on the side of history, I'm going to look at thousands of years over 47.
Yeah, and people will mock you for that too, because what happened 100 years ago, when the Fed started, is nowhere near where we are today. And without that credit expansion, we wouldn't have all the wealth that we have today. So you've got to be able to see both sides. And I try to do that as much as I can in my writings. And I think people find that refreshing, that I sell gold and I'm also honest about what I see with gold and with the dollar. But coming down the road, this is the first year that I've kind of flipped a little bit, and I'm going to be a little more adamant about having gold, and that's why I say half now and half if we crash one more time. And that's the last time. I don't see us ever going back under 1,000 again, or once this starts to take off over 1,700. I see us going easily 5,000. Avi just wrote about an article about 10,000. It can easily be done, and nobody understands how much trouble we're really in when it comes to an asset that has 47 years of existence, that's printed without regard to anything else, and continues to be printed. And one last thing, the Austrian economists have it right, and Barry and I discussed Austrian economics a little bit, but the one thing they concentrate mostly on is M2 and the money supply, and it's out of control. But they don't take an account the credit, and the Fed does have some power left. So what the Fed does is what the market trades on now more than anything else. And so you got to give them a little bit more credit than just a dollar analysis, although over time the dollar has less purchasing power and gold and silver maintain their purchasing power, again, over time. And there's nothing wrong with owning a little stocks and bonds and whatnot, but you got to understand where we are and have a little more control over them, and not be afraid to take some profit off the table maybe this summer. That's the way I look at it.
And again, trying to piece all the different things together. So you're seeing gold and silver over the summer. Again, this is, we're summer now. This is June. Oh, we're almost summer. It's June 2018. So you're seeing gold and silver potentially going to 1,500 this summer. But then September, October, some kind of unraveling beginning to happen. Maybe, big crash, or cracks in the armor start happening in the fall. Are you could you clarify that again?
Sure. For the summer into the end of August, beginning of September, I see both the stock market and gold and silver heading higher. We're long JNUG and USLV right now on the gold and silver side. We're going to be buying the dips in a lot of these triple leverage ETFs on the stock market side. This next 24 hours, 48 hours with Donald Trump and China going at it with their trade wars, it's a little sketchy as to what's going to happen. But into the summer, stocks and gold higher. Then come September, I will try to be as flat as possible and just kind of judge it day to day or week to week, see what the Fed does in their next report as to what they'll do with interest rates. And if they kind of change their language to where they're a little bit sketchy, let's say, and all of a sudden maybe even mention QE at some point, then the writing's on the wall. We've got trouble ahead. At some point, we're going to see that crash happen, I think. And I'm trying to pinpoint it to that October level only because if you Google October crash, you'll find even Investopedia has a history of the market kind of unraveling at that time. So it's kind of like in the psyche of the market.
And by crash, you're talking, financial crisis, like 2008, 2009 type stuff.
It'll happen again quickly, or
at least the beginning of that.
Yeah, it's going to be interesting to see where we are politically. But again, going back to Trump, if there's trouble and Democrats are going to start to look like they're going to win the House, then I would be in gold for sure, and guns. And
so you're saying, possibly $5,000 gold this year or next?
Oh, not this year. No, I'm not.
Oh, okay. That's I'm trying. I know we're squeezing a lot into a short period of time. So I'm trying to give a little bit of a clarity in kind of the next year or two for some people. But you're seeing by the end of the year, gold, pushing all-time highs. Is that safe to say?
I'm saying by the end of the year, be long metals and miners.
Gotcha.
For the long run.
Great. Man, there's so much here.
And maybe even cryptocurrencies.
Oh, look at that, man. Okay, that is a great drop in the bucket there at the end to kind of lead into another, because I was just thinking like another interview in terms of, because I'm sure there's going to be tons of comments and questions following this, and it may be fun to kind of do a follow-up interview as well. And I'm sure, of course, cryptocurrency obviously has lots of different opinions. Do you mind giving your quick hot sports opinion on cryptocurrency before we wrap up, and we can come back and do a follow-up another time?
Sure. First of all, I recommend you interview Ryan Wilde from Avi's group. He's the guy I would turn to. I'm a member of his service. I think he's someone that I would definitely interview with regards to where he thinks things are going. And right now, he says 4,700 on the downside, worst case scenario, and then from there we could be off to the races for a while too. I'm more of a trader. I can only trade GBTC as far as my trading service. So we do buy the dips in that sometimes, and we get 2, 3, 4%, sometimes more, and then we'll sell. But at some point, if we can get lower, I'll be a fan of it into the summer, see how far we can take it up. But my problem is when I'm up 10% in something, I usually like to take profit. And if anything, the Bitcoin can offer a bigger profit the farther it falls. So I'll leave it at that.
Gotcha. But you see cryptocurrencies, at least some of them, as benefiting in this scenario as well, to say it simply.
Yeah, there's a lot of potential in it. What does it mean to me personally? I don't even care if it's something I can trade.
Sure. Sounds great. Doug, as always, great to have you on the show. Thanks for giving us some of your time.
All right, Brian. Nice talking to you.
The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.